You're listening to The Wealth Advocates with finance experts John Mickelson and Patrick Jenkins. The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Well, welcome Wealth Advocate Nation to our first podcast, our first presentation on the state of the markets. This is something we do every first quarter of the year. It's 2020. We want to do a little bit of a look back on what happened in 2019, where we're at in 2020, and maybe some things we can expect throughout the year. So let's start out. John, tell us a little bit about what happened this year.
You bet. And we hope that this podcast makes our information a little more accessible. As we've done it in the past in different formats, we hope this will help people gain a little more education on what's happening. Last year was a phenomenal year in the markets for most people. And the primary drivers were four areas, and those are the things we want to discuss today. First and foremost, the monetary easing, trade, corporate earnings were a big factor. And then the last thing are the key market drivers, which we'll talk about. There's a handful of them that are kind of important ones to know what's happening with the markets.
Maybe just a little bit of a look back before we dive into where we've gone. I think there were several inflection points in 2019 worth noting, and they really fall into three categories. The first is going to be just the trade tensions that went on. The second is going to be monetary easing, and I think there's something worth saying in just generally the economy. So let me start out kind of in that reverse order. I've got my notes here. Monetary easing is probably one of the bigger topics. Jerome Powell, I'll refer to him as Chairman J. Powell, he's new to the federal chairmanship, comes in, and we really ought to back up a little bit further and talk about 2018 because this is where it all begins. October 2nd, 2018, Jay Powell, sitting at an investment club meeting in New York, talks a little bit about the economy, which is what the Fed's interested in, and the stock market. They're separate from each other. They operate autonomously, and he feels like it doesn't matter what the market does, the Fed needs to unravel their balance sheet. So again, we're in 2018. From that moment on October 2nd to December 24th, the market drops 20%, and it felt like 2008 all over again. There was a little bit of a panic, but systemically, the economy is going well, but that's the very first inflection point where interest rates were the driving factor. He subsequently walks back his statements right around the Thanksgiving time frame and begins to march forward. So then on January 4th, he starts to hint that maybe rate hikes isn't something we should be talking about, and we'll see what happens. That's what the term he starts using is we'll start to monitor the economy and make decisions based on data points. New information that he had not shared before. Then on the 30th, just a month later, Jay Powell again says, well, I think we ought to be patient about what's going on with interest rates. We ought to slow that down. Mid-June, we're going to jump all the way to the summer. That's when Jay Powell starts saying, well, maybe we need to back off interest rate hikes. Maybe the data suggests we ought to go the other way. Now, remember, at this time, we really hadn't seen a pullback in the economy. In fact, if you look at the graph all the way from January all the way through May, it's almost straight up. And then it starts to tip a little bit. This is where Jay Powell's talking. We probably ought to consider something different. He really implements that on July 31st. He does a rate cut of 0.25%. He does another rate cut on September 30th. This, again, the first one in June, signals a huge uptake in the market, and then the market starts to wane a little bit. And then in August, we're down. September, he does another rate cut. And October 31st, he does the Halloween third and final rate cut of 2019. Huge impact on the market broadly. And we see that the market and their inflection points respond almost identically. A second tier to what's going on in the market in 2019 is what's going on with trade. China seems to make the news a lot because they're one of our largest suppliers of products and goods. But equally significant was the trade agreements with Mexico and with Canada. And so you've got all these different trade agreements, and we shouldn't overshadow what's going on in Europe and in South America with trade agreements. We just don't have resolution there. We do have resolution now with what's going on with China, a first phase of it, I should say. We have resolution with what's our trade agreement going to be going forward with Canada and with Mexico. All those occur in 2019, and they play a role in the strength of the market in 2019. Finally, the third tool of this economic stool is going to be what's going on in the economy. So broadly speaking, every time we've gone through a quarterly earnings season, we've seen significant growth across the board. Some companies winning. If everything is going up, we have a broader problem. We have some market manipulation, or we have some inefficiencies in the market. We have something wrong. What we like to see is that 70-30 mix, where 70% of the companies are reporting strong, 30% are reporting a little weaker. Well, October 2nd, we see our manufacturing numbers, and it seems like prior to October, September is our absolute worst month in manufacturing. That also coincides with what's going on with trade. So I put that on trade. We have new trade agreements going on with China. We're trying to import things like steel, for example. That's slowing down our manufacturing numbers. Contrast that with what's going on in December. Just 2 months later, all of a sudden, those same manufacturing numbers are going through the roof. And then you put in that data point of jobs number. We have a phenomenal jobs number occurring on December 6th. The jobs report suggests 266,000 jobs were added in November. That's a lot of confidence, and investors can feel ending 2019 on what the economy is doing from those three angles. Those are real drivers throughout the 2019 economic cycles.
As Patrick alluded to, the monetary easing was the first major factor in the economy for last year, of the major ones that we can point to. One of the elements of that were the 3 rate cuts. Those were not really expected. We expected to have consistency and not see much activity from the Fed. As that happened, that had both a positive and a negative impact on the economy and the perception of what we can do in the coming years. As I talk to people and kind of evaluate the indicators that are around the market, one of the things I'll ask is, do you see a downturn coming in the next few years? And almost everybody says yes. And that would be normal. I mean, the one thing that we have to always keep in mind is the markets are going to continue to cycle. That's the one thing we're sure of. And when the markets are all the way up, we become much more bullish. And when the markets are down, we become much more conservative, which is that's counterintuitive to what we should do. What we should be is more bullish when it's bad, and vice versa. Well, with these Fed rate cuts, the positive is cheap money drives the market. And that's really a big impact of last year. Is it became much easier for businesses to expand and grow and have confidence. So it did have that positive impact on the overall market. The concern across the board that I've seen is what happens if the market turns, or when the market turns. And it will. Eventually it's going to have a pullback. So the question is, when that happens, if we say, hey, arguably we could say the market is going to turn in the next 2 to 3 years. Assuming that happens, will the Fed cut interest rates as a result? And if you look at reports from the last 3 or 4 Fed chairmen, they've all said that will be a result. The federal fund rate currently is below, I believe, 1.5%. If that's true, and we cut rates, that's one of the concerns about cutting it 3 times this year, is we've left ourselves very little room to work when things get rough. All of them have alluded to the idea that we could go to flat or negative interest rates, much like Japan or Germany. And that's a big concern in the coming years, because as we look at when we boil all this down to individual planning, which is what this is really about, cutting the interest rates, if we see a downturn in the economy, will be much like we saw this year. If things get rough and they cut interest rates, money becomes very easy. The economy will be expansive because companies will have confidence to expand if the costs are low. The negative, and especially for those that are within 3 to 5 years of retirement, is, what do retirees want? They want at least a portion of their money in a place where they can say, hey, here's a very safe, supposedly bulletproof area, and I want just kick off that safe income. Every month I want that reliable income. Well, if we cut interest rates to the point where they're at zero or negative, that's going to be near impossible to find. So there are things we can be doing right now in terms of planning to assure yourself that income going forward. Now, on the flip side of that, if rates are really low, as I said before, for those that are in stock or in real estate, that's going to be a real positive. I mean, eventually the downturn will turn around and it will expand the market. So those are a few things that I think are important when we start, moving from the quantitative easing into, corporate earnings and interest rates. That's a big concern. That's one shift that we will see in the next few years. Is it will be harder and harder for corporations to sustain the kind of earnings they're having right now. It's great when we're in it, but again, the cycles are healthy. They are natural. And eventually the markets will turn back and companies will probably expand beyond where they should, and they might pare off the fat, become lean and mean, and then they grow again. So that's one thing I think is important to keep in mind as we look at the next year, is we've come off a really good year. I mean, one of the big concerns is people are saying, well, it's been so good, should we be moving out because, it's going to come. It's going to be a downturn. And we have to be a little cautious with that line of thinking because there is no assurity that we're going to stop or slow down. I mean, we may, especially with the way businesses are expanding, we could still see some growth. So the big thing is, the one sure thing about the market is we're not sure about the market. But we do know how we will behave as those shifts take place, and that's important.
John, you do a good job of talking about the stock market and its impact on interest rates and its impact on the stock market. I really want to add some color to some of the changes that occurred in the economy, especially with global trade this year. I think there's some data points worth talking about, and maybe you want to add some editorial to this too. Really big year for global trade and global trade changes. On March 24th, President Trump announces that the tariffs targeting China will not be raised on March 1. So he pushes this out, and it adds this element of indefinite to what could be a global trade war. That's a huge deal to the economy. And really, that's kind of where we started to see a little bit of the slowdown in the manufacturing. On May 5, President Trump then threatens tariffs on additional $300 billion of Chinese goods. So all those iPhones that are coming in, they come in with a tariff. June 7, we see President Trump calling tariffs on Mexico imports. So now we've got China imports, Mexico imports, anything that's coming into the country, and frankly, fairly consistent with his America First campaign and his drive to bring more product, more manufacturing, more jobs back to the United States. In that sense, he's delivering on a promise on, looking back on 2019, the frightening period, because this is so much of our economy is importing. August 5, this is a big day. August 5 is when the U.S. labels China as a currency manipulator. If you can't benchmark, if you can't expect that another country's currency will tie to the U.S. dollar, it's really hard to start to do international currency exchange. And frankly, all year long, international investments have been very, very tough. We see in October 11th, the U.S. announces a phase 1 trade deal agreement in principle with China. And I think this is really where we see that first inflection point that's based just on trade, not on interest rates. On October 1, when they say, okay, here's what phase 1 looks like, this is our intention, we start to see that market really take off. And it speaks a little bit to the strength of the U.S. economy right now, because we're fixing some of these systemic issues. On October 18th, U.S. imposes tariffs of $7.5 billion on Europe products. Again, another tariff on another country. And on December 2nd, the end of the year, President Trump announces reposition of tariffs on steel and aluminum imports from Brazil and Argentina. And this is that Southern American import that I mentioned early on. Those aren't fixed yet. Those are still concerns that impact the broader market. So interest rates, a huge driver, somewhat overshadowing what's happening on our global trade. There's some concern, even as of February 2020, that some of those economic issues that impact that are going on internationally may actually bleed over to the U.S. and it's an ongoing concern. John, why don't you talk to us about where we're at now, where we're going?
So one of the things that I think has been on people's mind, and a part of this is just a reaction to a lot of pain in the past, and that is there some kind of parallel between now and 2008? We hear that all the time. People bring that up and say, are we in for a crash just like in '08? So if you look at the dials behind me, the thing I want you to point out is notice how many dials there are, whether there were 12 or 13, 14 dials on there. These are the major contributors to the direction of the market. And so these are some of the factors we look at as we reallocate or change portfolios, or we look for some sense of what direction to take. Knowing that we don't know the future, and we don't know, one of the frustrations in our job, as opposed to a lot of others, I joke a little bit with my clients that are engineers because their life is a life of precision. A equals B equals C. And in ours, you think that you've got all these things dialed in, and then it goes exactly the opposite of what you thought, and it makes no sense. In fact, a good example of that, if you had asked people before the impeachment trials, what will the market look like during the trials? I'll bet most people would have said, it's going to be a landslide. It's going to drop.
That's what we saw in the 90s during the Clinton impeachment.
Yeah. And so it was fully what everybody was expecting.
Yep.
And what happened? Nothing.
It went up.
Crazy things that happened in the impeachment trials, and everything stayed the same or went up. And so it was not predictable in any sense, and it didn't have any negative impact that we could really sensibly perceive. So the point with that is, notice that this is 2008 behind me. A couple of things that are close parallels. There are issues with, for example, right now with the expansive economy, one of the natural consequences is people have more money, therefore they will pay more for goods and services. And you're certainly seeing that in real estate. Real estate, locally and nationally, has grown dramatically, has inflated dramatically. And that is a very frightening parallel for a lot of people when they look at 2008 and today. However, one of the major differences between 2008, two of them really, one is the demand for true economic information about the person borrowing money. That didn't exist in 2008. Today, you do have to prove you can actually pay the money back. The second factor is, in 2008, is the amount of vacant real estate. In 2008, there were just all these speculative homes, empty homes that people were going to flip and change and just purely look at as an investment. There was nobody in them. Today, we have a housing shortage. And you see that locally, you see it nationally. There are not enough places for people to live for the size of our population. So those are completely different environments, which the latter two should help us have a little bit more stability through a downturn. Now, again, do we know that? No, we don't. But those are indicators that help us. So go ahead and move forward. If you look at last year.
Here we are in 2019, January 2019.
Yeah.
So let's look at those as contrast.
Over a year ago. So if you look at January, what were the indicators? They all looked, look how many are green or yellow. Those are positives. They're saying, hey, we're in a good shape. Notice the two that are red. The two that are red are geopolitical risk and political risk nationally. And so I don't know, even if you look forward, we'll go to that in the next slide, but those haven't changed. One of our biggest concerns are things like North Korea, or really it's the unknown. One thing we know about countries, and eventually they don't get along. Yeah. And that creates stir. And again, it also argues the point that people say, the markets, you can kind of figure out how to make it work, and it's always going to work to your favor. This is a great example. There are inefficiencies in the market you cannot predict, and they will always be there because of the human element. The other thing is that people will act in a rational way. They won't. We are human nature. We follow our emotions more than we are willing to admit. Patrick, you and I get calls every time there's a disruption in the market, and it's always the same question: should I get out until things get better? Now, that is a dangerous statement, in my opinion. It doesn't mean we do nothing. I'll address that. But what it means is, if someone says to me, should I get out till things get better? The only reason they're going to bring that up is, I felt pain. I have lost money, or the market has gone down. And should I get out? Now, by getting out, you have assured yourself of losing the money. It's done. You sell out, and you go out to the sidelines. We go to cash or something conservative, And you say, until when? Until things get better. What does that mean? That means until we see some positive upswing. Now, in any downturn, I don't care which one you look at, the best part of any recovery is the initial burst. And you've just guaranteed yourself you're not going to be in it. So, in my opinion, the most important thing is to not necessarily stay the market. I mean, that's true. But it's when the markets fall, very often I've heard the analogy of sailing versus rowing. You know, in the markets where it's like this, where it's green and everything is going well, you know, the wind is pushing you. You don't have to do much. You know, when you look at a 2008 and everything's bad, get out your paddle and start digging in. And that's really what we have to do, is you'll see a lot more activity, meaning we only move from emerging markets to a better emerging markets, or small companies to better small companies, but we don't get out. We don't try to guess at when those markets are going to turn, because that is fraught with error. So I think those are some important points. If you look forward to what we expect, okay, so this is what we are projecting onto this year. And I'm going to share a quote to start this off. So when we talk about projecting forward, especially given how many times I've said the things we don't know versus the ones we do. So here's my quote. We have long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie Munger and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also away from grown-ups who behave in the market like children. That's, of course, a Warren Buffett quote. But anyway, I thought that's a fairly accurate statement that, there's just so many things we don't know. The important thing is to really build your portfolios and build your planning around what you do know. One of the most important things that you need to know that you may not know is, what does it mean when you say risk tolerance? What am I tolerant to? What am I comfortable with? You know, going up and going down. Because you can go to one extreme and you go to cash and bank assets, just something very, very conservative. And that has a struggle with keeping pace with inflation. And you are losing money by losing value. On the other end, the big swings up and down and not being able to recover. There's another topic we'll address in the future called sequence of returns. When do you take money out, and how damaging it can be to take it at the wrong time? Those are the factors that come into it. But the important thing is, whether the markets are up or down, you need to resolve how comfortable you are with risk and what level of risk you want to stick to. And then when the markets change, don't get too far off of that number. Stay with who you are. Stay consistent with what you're comfortable with. Because the storms are going to come, and the important thing is how we behave when it gets tough. That is an important aspect of any plan. So, Patrick, any other
good solid feedback, John? Let's pull the poison out of the cupboard and start talking about forecasts. So I want to talk a little bit about, I think inflation forecasts is what I'd like to talk about. And I'll let you talk about this next slide, which is interest. But inflation, you bring up inflation just a little bit ago, which is it's the price of goods and services and products becoming more expensive, or the dollar buying less and less. And over the last little bit, we haven't seen a lot of inflation. And there could be a whole bunch of different reasons for it. I like to believe the Fed is managing through inflation well. Another more cynical approach is, every time they say there's inflation, we've got to give all those seniors a pay raise on their Social Security. However you look at it, there's not a lot of inflation going on out there. And frankly, if we were talking right now, that dollar is buying more goods and services and products than it ever has before. However, on the horizon, there's some concerns out there. First and foremost, that unemployment rate is so low, and we experience this in the office, and maybe some of you watching and listening experience this. Trying to find people to hire costs a lot more than it used to. And that increase in labor costs could be a real shortcoming in the future of the economy. So again, something of a short-term forecast, but inflation is a concern, and frankly, labor is only one of those elements that cause inflation.
But labor is a leading one, and I think that you hit a good point, and that is, especially as we look at the inflation on real estate, I mean, you have to reverse engineer that and say, at the end of the day, someone has to be able to pay for it. And if we don't see, and we have not seen a lot of wage growth nationally or locally, it has not gone up all that much, but yet the costs of the real estate have gone up a lot. So at some point, you're going to say people just can't afford to buy or pay for that real estate anymore. And that's where we could see a correction, or we could see inflation in wages, which in some ways may be healthy. It's a hard thing for a business, but a good thing for the ability to expand the market and actually meet that. But right now, we have seen so little inflation in the last few years, and we all expected it. I mean, in the last 10 years, everyone kept saying, oh, eventually inflation's going to come back up a little bit and we'll have to raise rates again. It just hasn't happened. The other thing that's important that you touched on is on those seniors that are looking at their pensions and Social Securities, and they're tied to inflation on those increases. It's hurting. I mean, as much as they may be able to stretch those dollars, their budget is not increasing on those assets fast enough to keep pace with the costs going up. Okay. That's an important thing, and also argues the point of having something else that does. That's on a little bit on the safer side, but you can still see you're going to keep pace and grow. And then those that are in a little bit of a growth mode that have time, the stocks and the market have benefited from the fact that it's been very low inflation and it helps the expansion.
Excellent points. Excellent points. Now, in the spirit of forecasting, yesterday, and we're recording this in February of 2020, but yesterday Jay Powell testifies before the Senate, and he talks a little bit about inflation or interest rates. Tell me about inflation rates in the forecast. What do you see happening?
Yeah, there wasn't a lot of indication that we were going to see a lot of inflation coming. I mean, they still forecast that we will not see a great expansion on or a great rise in inflation coming. The one thing I know about that is when inflation has reared up, a lot of times it's been as a surprise. And so I think you cannot ignore the fact that it could happen, but it doesn't look like there's anything on the horizon that would give us any indication that that's going to happen.
That's good. That's good. Let's talk about another concern that I have out there, and that's just the broader forecast. We bring all these little elements together. What does 2020 look like? And feel free to interject here. But most analysts I'm reading, they are optimistic, cautiously optimistic, though. There's a lot of, to use another term, a lot of bear traps that we want to keep our foot out of. And so a volatile year, but a year of growth. And you have all kinds of things come into play here that are unique. You have all those new tariff agreements and trade war settlements, and you have all this new manufacturing that's coming back to the States, and you have low interest rates, and you have potential inflation, and it's an election year. So you bring all that together, what does that mean? Yeah, who of us knows? This is that poison that Warren Buffett talks about. We got to keep out of the hands of the adults and the children and keep back in the cupboard. But I think modest growth throughout the year. I think it's going to be a good year, but boy, a volatile year. What do you think, John?
Yeah, and I think that a lot of people, when we looked at all those dials, a lot of people attribute a huge portion of movement to political risk. And so the election has got everyone... I mean, that's probably the number one topic when people come in is what will happen between now and November. I do think it seems to me that will create just the self-fulfilling prophecy of how people behave, I think will create a lot of volatility. The unknowns, which side will win? Is it going to go as expected? I mean, there's a lot of people that act like it's a very obvious direction right now as to how the political environment's going to go. I would remind everyone, we thought that in the last election, and it did not go where everyone thought. So the unexpected is to be expected. But I think that, as we look at this year, and let me back up and say, last year, I mean, you had so much opportunity. There was just so many places commanding attention that would be really, really good places. This year, I think there's a lot of opportunity, but you've got to be a lot pickier than you were in the past. You've got to be more sensitive to, the projections that are created or the look at future growth. It's not going to be as easy following a big year. Every year will get a little bit harder to sustain that kind of momentum. So I do think cautious optimism is a good term, but at the same time, I just think continue to do the things that are reliable and predictable. Rebalancing, using cash appropriately, making sure you have the right proportions of money in the right accounts so that you have money when you need it, even if things are rough. Those are the things you should be planning around, especially now while you've got up markets. Do I need to replenish some of those places so that I'm prepared for a downturn? But at the same time, you've still got money in the right places for opportunities that are around us.
Excellent points. Excellent points. Well, there you have it. My gosh, we went through what happened in 2019, where we're at right now. We even threw out some flavored, cautious forecast, the poison that Warren Buffett talks about. John, what do we do from here?
Drink the right poison. From here, it is more about, especially in this first quarter, assess risk and make sure that you're holding good, strong companies. Make sure that you're investing in the right places. That's the biggest concern I have right now is the expectation meets what is actually happening. And that's where I've got to be on the same page with my clients.
I think a big takeaway from all of us here is we're cautiously watching your accounts. We want to make sure it's performing at your level of risk. And as things change, we'd hope that you would reach out to us. Let us know. Keep us in the loop. We proactively reach out to you frequently and tell us any concerns that you might have. And also, just as important financial, legal, tax decisions are made, we want to be a part of that. So from all of us at Wealth Advocates, thank you for tuning in.
Thank you for listening to the Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for the Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by calling or texting the Wealth Advocates office at 435-754-7888. Learn more about the Wealth Advocates and how they can help you by visiting wealth-advocates.com. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer member FINRA, SIPC. Member FINRA, SIPC. Advisory services offered through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Wealth Advocates and Cambridge Investment Research Incorporated are not affiliated. Thank you for listening to the Wealth Advocates.